because one of our great strengths has been the ability to start new businesses. We do it more and better than any other country in the world. That's how we get the new giants of each generation, starting small and then growing. Hundreds of thousands of businesses started each year, productive businesses, not just tax dodgers and the like. We see it today in the way the Treasury Department and the Fed are dominant in the short-term lending market. They're now paying banks 5.4% on the reserves. And what that means is that's less capital for small businesses to buy equipment, to buy more inventory, to start new businesses.
In this bonus episode of the Money Masters podcast, Kathleen Hays of Central Bank Central sat down with Steve Forbes to discuss some of the topics he touched on in his presentation at the MoneyShow TradersEXPO Las Vegas.
Hi, I'm Kathleen Hays. I'm here at the Las Vegas Money Show with a very special guest. In fact, he was a presenter. He is, in fact, also presenting his relatively new book, Inflation, which I highly recommend. But let me get straight to the point. Steve, as you know, is the CEO of Forbes Media, Forbes Magazine. His hundreds of millions, basically, of people are watching him on his new podcast, What's Next? So many things around the world. I guess I better start talking to you because the intro is just going to get longer and longer.
No, you can keep going.
Well, anyway, you covered a lot of ground today, and I think I'd like to start on the Federal Reserve, because when we think about one of the things that's driving markets, not just early here in 2024, but coming into this year, inflation seems to have peaked. It certainly has come down from that horrific peak of 9% back in whatever that was, end of 2021. And markets are expecting the Fed to cut very soon. They've been signaling all of a sudden that they don't know. They're going to cut probably, but not right away. Where do you see the Fed now, and what do you see them doing next?
I think the Fed is confused, and one of the things that's happened with the COVID lockdowns is that it's, I think, discombobulated every economic model. When you shut down an economy or change it like you had in World War II, the old models don't work, and so it takes time for things to get back to normal again, to readjust. So that's why you have inverted yield curves. That's why you have low unemployment with higher interest rates. What would normally happen doesn't happen. And so I think the Fed is still enthralled, many of them, with the what they call the Phillips curve, that prosperity causes inflation, which it doesn't. But so I think they really they're trying to figure out what do we do next. And one of the things that they should be looking at is with the high interest rates they're paying on reserves, and with their still large number of reverse repurchase agreements they have, which is a phenomenon, they are actually hurting the lending market. So the Fed should be focusing on less on trying to manipulate the economy or guide it, and more on how do we get the capital out to the markets again where they allocate the capital.
Let me ask you this. So, and let's take the Fed and the interest rates part first, because I definitely want to talk about the balance sheet. That's becoming, in fact, they said they're going to talk about that at the coming meeting in March. But in terms of interest rates, it does seem clear, and even people who are people who accept the Fed model, and they think it might be hard to figure out right now, but they're still on board with that. They too kind of think maybe things have changed. And there's this whole discussion now about, well, when are rates restrictive? That's what the Fed's trying to be, is restrictive, right? But if you have the funds rate still at 5.25 to 5.5, and you have labor markets looking still solid, if not strong, there are other indicators that, this doesn't look like an economy heading into recession, then does it really matter that much if the Fed starts cutting rates now or doesn't start cutting rates right now if they don't seem to be causing harm to the economy, potentially?
I think they should be looking at the shorter work week. That is not a sign of an economy heading into brighter waters.
From the last jobs report, yes.
And they should also be looking at the lack of growth in commercial industrial loans. They should be looking at why are we putting more capital requirements on banks. totally unnecessary. It was after 2007, 2008, but now enough already. And trying to figure out how, again, let the markets revive. So if anything, I'd advocate them reducing rates, not to stimulate the economy, but to free up funds for the smaller business market.
So let's follow that thread, because that's a very important one. And when you talk about banks, since the great financial crisis, when big banks got bailed out and they ended up with even higher percentage of the total deposits in the country, that's one of the first or most recent big things that happened to put the small and medium-sized banks at a disadvantage. Then we had last year, March of 2023, when SVB, Silicon Valley Bank, got hit, and it seems to be a bigger issue than it was, and some people do think those banks are still holding a lot of bad assets.
Well, one of the things that happens is when you have distorted interest rates for 15 years at levels that have never happened before in human history, negative interest rates. I'd love to see what Sidney Homer, the great man who wrote the definitive books on interest rates, would say about what happened. And so people became accustomed to it. And so when the world finally changes, people are caught. And what works with 3% may not work with 6%. And so what you had was this explosion of worldwide debt, both from the private sector and from governments. Look at Japan's balance sheet. Look at other countries. Well, the money was free. It's like putting $10,000 on your credit card and your monthly payment went down. So what's not to like? Well, now we had a period where, there's a lot not to like.
So when you get to the balance sheet and you get to the concern about reserves, reverse repos, one of the concerns, of course, is they think there's not going to be enough bank reserves in the system if they keep doing quantitative tightening. But when where do the small and medium-sized banks come into this? And do you see actual signs, evidence, data that show that they are working at a disadvantage, especially compared to big financial institutions?
Well, when you have the kind of environment they've created, volume counts. But it's artificial. It's like the great consolidations you're seeing in the healthcare industry. It's because you don't have a real free market. And you're seeing the same thing happen on the financial side. So you need true deregulation. They should go back 20 years and ask, why aren't banks making loans to small businesses? Why? And it's after 2000, especially after 2008, where you have to have 6 piles of paper to justify anything. And so you had to have compliance officers more than loan officers. And that put a crimp in the economy, so it leads to alternatives, which has the regulators up in arms. Oh, these shadow blah, 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 blah. This is another source of instability. No, they're the source of instability. Step back and let this thing sort itself out.
Markets, particularly the stock market this year, it's just,
Well, that's another thing that's astounded them.
Rushed into, 2024.
Yeah, 2023 was supposed to be a terrible year. It wasn't. The market, especially NVIDIA, is doing boom business this year. And it's a part of its anticipation. We forget there's a heck of a lot of liquidity out there. What, 6 trillion or whatever number you want to pick. And that wants to find a home. And so big companies are, many of them are well liquefied. But to see the craziness of what the Fed did is here you had a few years ago Apple, the biggest money machine in the world, going out and selling bonds and borrowing money. What? Over $100 billion. Why? Because the money was free, and if you paid interest, it was deductible. So they totally distorted the markets, and it's going to take time to unwind them. So I think if they stop approaching banking with hostility, that they're just going to wreck things, it'll be good. And one of the other danger things is that Yellen's all in favor of it. These international institutions, I mentioned Basel, but you see it on this trying to have international tax systems. and climate change and all of that, they impose huge regulatory burdens, and only the biggies can cope with that.
In terms of 2024 election year, presumably it won't directly affect the markets, right? I mean, I don't know, in terms of sentiment, I guess, or anything that could happen in the campaign itself, that would, but obviously, once there's a new president in the White House, and maybe even going into that, that's when people get a better sense of who the person is who's going to actually...
And then what is going to have to be dealt
exactly.
with. Shutting down the government again. You've got that coming in early next year. And you've got to do something about expiring tax cuts from 2017. You've got to deal with the entitlements, not in the root canal way, but a more positive way, but start to deal with them. And then you're going to have the need for a major military buildup, which is going to require a defense secretary who, one, shows up for work, but two, is going to make reforms on the procurement system, which is a disaster, very wasteful and just time-consuming. One of the things we should be doing, for example, is since we're falling way behind the Chinese on shipbuilding, why aren't we working with Japan and South Korea, who know how to build ships, have the yards, and start laying down some of the keels for a rebuild, submarines and everything else? So the new president, a lot of work, which is why you probably will get the continued phenomenon of the first year of a new president, the market doesn't do very well. As a new president learns what the real world is like, they'll inevitably make mistakes. But the key thing, as we saw with Reagan, is that you start planting the right seeds, and then it'll come together. But right now, there's this sort of complacency. For example, just the other day, inadvertently, by accident, the Taiwanese Coast Guard hit a Chinese Coast Guard vessel that was harassing Taiwanese fishing boats, and inadvertently killed two Chinese nationals. And that kind of incident can spin out of control. The boats came out of what they call Kinmen Island, used to be called, back in the 1960s, they had a different name for the island, but Quemoy, called it Quemoy back then. But anyway, what if the Chinese start lobbing shells into Kinmen, an island that's controlled by Taiwan? What are we going to do? When they tried that back in the 50s, Quemoy and Matsu, Eisenhower behind the scenes says if you make a move on those islands, we'll use nuclear weapons. It's hard, doesn't get much mentioned today.
No, not at all.
So, but in the situation we have today, where you have a president who utterly lacks the credibility of a former general, who, with a weakening military vis-a-vis what they're doing, things can spin out of control, and that's one of the dangers.
I guess so, and that's something that could definitely happen over the past or the coming few months, right? I mean, all these things at a time when the Republicans also, though, don't seem to be very. They don't seem united on getting things done in their own party.
No, they're dealing with trying to have election issues, not realizing they got plenty of issues. Oh, well, if we cut something, that will take away a weapon against Biden. No, they should be coming up, as Reagan did back in 1980, with a big tax plan. Back then, rebuilding the military and positive things, and people felt this is a government that would be a government that was going to make some very positive changes. That's how we won. And we don't see that today yet, unfortunately. And the idea that if you starve Ukraine, that'll make Putin behave himself, means read the 1930s.
Well, I guess that's the last thing I want to ask you, and I think it's just because it's last doesn't mean it's not important, but that is Ukraine and Russia. Because what is it? It's almost 3 years now. The Europeans, I love the former Prime Minister of the Netherlands, Mark Rutte, said the last few days to his fellow EU colleagues, hey, we've got to stop whining about Trump and figure out what we need to do and what you know.
And what, apropos of what he said, we need a president who will spell out a real new strategy for the world we have today. And that's one of the things that's happened. Biden's never made an address. What are we doing over there? Why? Is this another Afghanistan? It isn't, but he's never explained. He's incapable of it. Unlike after World War II, which Dean Acheson there became Secretary of State, called At the Creation, and was the title of his memoirs, putting in creating a whole new world order. And so the question is, in the post-Cold War world, are we going in a larger sense, making the mistakes of the 30s, or are we going to do what we did after World War II? We got it largely right.
Okay, I really am getting to my last question now. So we put a lot of stuff on the table. There's some big risks. If we can assume that we get through most of this year and none of these political risks, geopolitical risks blow up, what do you see the stock market doing? Do you think this is going to be another strong up year?
Yes, just because the future is always easy to anticipate before the reality sets in. But, we've gone through such crazy things, maybe the pattern won't hold. But the upending of what you might call normalcy has gone by the boards. And the whole thing what the Fed did, who would have conceived 12 years ago, 13 years ago, 14 years ago, that we'd have central banks bloating their balance sheets the way they did. Operation Twist, that was junk from the early 1960s. And here they came back again and put it on steroids. And again, it's this hubris that central powers can guide from above. And as they're discovering with EVs and electric stoves, the gas stoves, no.
Yeah.
Got to take account of people. Oh, we're not machines.
All right. Well, look, thank you so much, Steve. It was
Thank you,
great
Kathleen.
talking. We'll have to do it again soon because we got to stay on top of all this stuff. We got to keep track of it.
Well, you do, so I'll come and get my talking points from you.
Okay. Steve Forbes. He is the CEO of Forbes Media, and I thank him so much for joining me today, Kathleen Hays, here at the Money Show, Las Vegas.
We'll be publishing more interviews and bonus episodes recorded at the Las Vegas Money Show Traders Expo. So make sure you subscribe to our channel or follow the Money Masters podcast wherever you get your podcasts.